But the first rates Monday morning on your screen, 45 points higher for the Nifty, 150 points higher for the Sensex. IndusInd Bank, Maruti, Hindalco, Hero MotoCorp. Not too many companies came with numbers over the weekend, but the ones which came out with numbers too. IndusInd Bank had to bounce back because the market reaction, I think, frankly, was overdone on Friday. Britannia is the one where numbers have been strong, commentary has been decent, margin expansion has been decent. Paytm, now it's flying. They continue to deliver, they continue to promise that we are very clear that we will be like any other company which focuses on cash flow. And the growth, I think, is just organic. I mean, they are they are not at the cusp of a high growth, but they are now really demonstrating that what this engine can actually do. 29 rupees higher for Paytm, 718 rupees. Let's also look at Zomato, Marico. Zomato, why? Because over the weekend, a lot of social media was talking about the impact of ONDC on food delivery, so I think that's having impact on the stock per se, which is at 64 rupees. And then HDFC Bank and HDFC Limited, the real whipping boys on Friday because of the Morgan Stanley implication, because MSCI implication, I beg your pardon. 10 rupees higher for HDFC Bank, which is bouncing back, and for HDFC Limited, post numbers, the bounce back I think is slightly better.
Let's see what IndusInd Bank is up to, because the market was a little spooked about that move on the stock price yesterday, or rather on Friday. R. Mayappan has resigned as the CRO and Sachin Palange has been appointed as the COO. IndusInd Bank has seen a massive recovery this morning, almost headed in for a 4% gain. Britannia, the big stellar performer in terms of earnings, the margins have come in at almost touching 20%, managed to post a good beat, 1.5% higher for Britannia as we speak right now. Marico as well came out with its numbers, which have largely been in line. The domestic volume growth stands at 5%, so it seems like it was a very Dabur specific story, because it clearly hasn't rubbed off onto Marico, which would be, I guess, the closest peer. Marico has gapped up 8.25% as we speak right now in trade. There's ICICI Lombard, there's Paytm, there's DCB Bank, Sundaram Clayton. They've all come out with their numbers, so look out for all of them. As is DCB Bank, by the way, wherein the NIMs have come in at a 22-quarter high. The operating profit is up 26% on a sequential basis. DCB Bank gaps up 5% as we speak this morning. There's also Star Health. The market share has come in higher by 21 basis points. The April premiums have come in higher by 25%. 605 is where that stock stands. And then, of course, there's Ather Industries as well. We just highlighted the numbers to you. The revenue has come in higher by 25%. Margins as well have seen a fair amount of expansion. Ather is holding up now around that 1,000 rupee per share mark. There's Lupin also, which has made a small acquisition of about 165 odd crore rupees. There's Thermax. They won a 272 crore rupee order, so look out for that stock as well and what it does in trade. And then, of course, there's Hampo Sugars as well, which has come out with a decent set of numbers. So that's another stock which is in focus also this morning. US FDA has now said that Mohali unit for Sun Pharma is not operating in line with the consent decree. So my sense is there would be a negative reaction on Sun Pharma this morning, down 1% as we speak right now. Coal India came out with its numbers. The blended realizations have come in higher, but the EBITDA has come in much lower than what the street was anticipating, 2.5% lower for Coal India as we speak. There's Piramal Enterprises, which has come out with its numbers. Adani Gas, Adani Transport as well in focus. MSCI looking to reduce the free float in May review meeting. And a couple of other numbers, Alembic Pharma, New India Assurance, Tattva Chintan, they've all come out with a bit of a disappointing set of earnings. But where is the index settling in at? Not seeing a bad move actually, about a 0.5% uptick and a very stock-specific result-oriented take on it.
Yeah, it seems to be an okay day for the indices. At least we've recuperated on the Nifty and the Bank Nifty by margin of 30-40% approximately from what we lost on in terms of the respective gains. The stock which I would look to trade in the open would be on the mid-cap front in Havells. I think it's a very strong chart. The last 3 or 4 days, the stock has done exceptionally well, moved from 1200 to now nudging towards the 1300 mark. So it looks attractive for at least another 80 to 100 points on the upside over the near term.
Norresh, let's find out what's looking attractive according to you as well, as we're checking in on the first rates at around 18,160.
So that would be a buy on Ambuja Cements. The stock is sustaining above the 400 mark. Has an upside towards 440 as a trade, keeping a strict stop loss at 390.
Mark, RVNL, that's just been this crazy stock of last 1 month. And today it's falling prey to some correction. 142 suddenly has become 136. So RVNL is on a decline. And before I look at intraday decline, last 1 month, one low, 85% higher. 85% higher for RVNL. They become Navratna, that's about it. But there are crazy moves which are there in some of these, the railway stocks now. What was like an ugly duckling now suddenly is trading at a Humpty Dumpty valuation. Year and a half ago, everybody thought defense is the only way railways will not do well. But allocations for railway, every budget has gone higher. But some of these companies again run projects which are long gestation projects, which is that you get the order right now, so the order book will look bloated. But the execution timeline for some of these railway companies is that 3, 4, 5 years. RVNL does get a lot of business from consultancy, but that's also a long gestation project. So you got to just be slightly careful. The long-term picture for railways defense is great, but 75%, 80% higher in the last 1 month, you could ask yourself, wow. Because when these stocks will reverse and they are not institutional dominated stock, you will see them, the fall will be higher than the rise. That much I can guarantee. I'm going to change gears and connect the Rajiv Thakkar, CIO with PPFAS mutual funds. I mean, this entire mutual fund, we've had the pleasure of tracking it for years, and what an extraordinary success story it's been. Started with a 150 crore corpus. Now how much are you managing? 25,000 crore, right?
38,000 across the both schemes. Flexi cap is around 33,000.
Wow, isn't that incredible? I mean, that's what India is, right? You do something differently and keep on doing it again and again with a simple thought process, you'll hit a home run. So congratulations on that. So what are we starting with? Are we starting with Buffett? Are we starting with your own success story, or are we starting with where are you finding value in this market?
Anything except our story. We are here to talk about the markets. People are interested in the investment environment.
Let's start with the last one then. Where are you finding value in this market? Where are you finding value in this market? That is a very simple question.
Banking sector, I think. Probably I can combine Buffett and this question together, because there was quite a bit of discussion on banking stocks as well in the Berkshire meeting. So right now in India, we are in a period where banks have cleaned up their balance sheets. All the earlier corporate credit losses were cleaned up. Then COVID provisions and people have come out of COVID quite well. So today they are sitting on clean balance sheets. The market share shift from PSUs to private sector continues. Given that interest rates are higher, the CASA rates are, CASA benefit is coming in where these spreads can be higher. And we don't have the problems like excessive lending to commercial real estate or problems in terms of huge amount of bond losses and things like that. So I think in India, banks are quite well placed. I would think that they are trading at multi-year low valuation multiples. That is a space that we are quite excited about. There was quite a bit of discussion on the banking sector in the US as well. And a very interesting point which came out, and which at least to my mind I was not aware of, was that if the law had not changed, Berkshire would not have entered insurance and would instead have put all the money in the banking space, and they would be among the biggest banking sector owners today in the US. And they clearly mentioned that banking can be a very attractive business to invest in if it's run sensibly and if people don't do any esoteric stuff and risky stuff. So that was quite interesting to me over the weekend.
Oh yeah, it was, and very categorical mention that banks should remain banks and not get into consulting banking. Or rather investment banking. But Rajiv, the other thing that really stood out over the weekend at the AGM was also their opinion on AI, right? And, Warren Buffett categorically saying that if AI can tell me what stocks to buy, then I would acknowledge its presence. That really was a big takeaway.
So, amazing, Aisha. kind of tinkering around that these people are doing at their age. So the most interesting thing that stood out for me about Buffett and Munger talking about AI was Buffett said that Bill Gates had given him some tools to play around with and to explore what the technology can do and cannot do. And that to my mind was amazing, given that Buffett has this reputation of being someone who does not know how to use technology and stuff. The interesting point that came out in that conversation, and it was almost a debate between Munger and Buffett, where they had a little bit of divergence in opinion. Munger was advocating being prepared for lower returns because of all these developments, whereas Buffett said that with all the technological developments, with data available very easily and things like that, still the focus is shifting to the very short end of the spectrum. Everyone is wanting to know what will happen in 1 quarter or 6 months or 1 year. And that actually creates more opportunities for people who have somewhat of a longer term thinking.
Rajiv, hi there. And, just to take stock of some of the other comments as well made, Warren Buffett sticking to his age-old advice about index funds being a great investment opportunity, and also talking about how there's going to be a time of correction in excessively valued companies. If you could just, elaborate a little bit more as to what your thoughts are on that, because we still continue to get, quite a bit of there's a lot of curiosity as to whether or not in an environment like this, index funds are the way to go.
Sure. So about the excessively valued companies, we were in a period just a few years back where trillions of dollars worth of bonds were trading at negative yields. Now, at such a time, any kind of story was flying in the private equity space as well as to some extent in the listed equity space, where people were not worrying about the current economics. They were buying into long-term market share growth stories, and there would be profitability maybe 10 years out, 15 years out. Now that interest rates are back to more or less normal levels, now if let's say dollar cost is 5% or 6%, then obviously people are not going to buy into very, very long drawn out decadal kind of stories. People will want some path to profitability. So I think that mean reversion in the startup space, in the loss making space, as well as some of the very highly valued companies, that is coming about. On the index funds, so for a while now, we have been seeing where because of the high expense ratios in the especially in the PE or those kind of space, or in the hedge fund kind of space, where people have not been able to beat a simple index fund. And there is, even in the active managed mutual fund space, in a lot of spaces, there has been a challenge in terms of beating the index. So people really need to pull their socks up. This is, I am talking about the asset managers. And for a new entrant into the market, someone who does not want to take the time and effort to find managers or fund houses which in their estimate will beat the index over the long run. For them, it's a very simple task. Invest regularly, invest in the index funds, and just forget about it. So I think that's very valid advice for a large section of the population.
Okay, fair enough. Let's get to talking a little bit about the sectoral bets as well, then, Rajiv, and what the outlook is when it comes to the entire financial sector. Just apart from that, the fact that you also have the Berkshire AGM alluding to the fact that, a lot of those well-managed banks are great businesses. Apart from that, if we were to even expand that and look a little bit at some of the other sectors, maybe even export-led sectors, what would be the outlook there, say IT?
So one is, again, I'll allude a little bit to what was discussed in Berkshire. Berkshire usually does not give revenue or profit guidance, but this time it seemed like there was some sort of an exception where they said that 2023, the operating businesses could see profit drops because they are sitting on a lot of inventory. There would be demand is weak. There may be a need for discounting stuff, and there would be revenue losses and profit losses as compared to the previous year. So the economic environment is clearly weak in the Western world. So at such a time, I think export-oriented sectors or the IT services could have a tough 6 to 9 month period. However, we have seen the prices coming off quite significantly. So someone who has a longer term outlook could look at selectively buying in this space, but the near term outlook looks difficult for these kind of companies.
Sure. Rajiv, just getting back to your own investment, strategy and play in the market right now. You talked about banks, but where else are you increasing or have already, increased exposure in the last 52 weeks?
So this has been in a space where traditionally we have not been investors. It's actually something different as to our regular investing style. This is in the space of the PSU and commodity kind of companies. So to my mind, the fall in the stock prices has been severe, and these companies have underperformed for a very, very long time. And on the flip side, what we are seeing is that from the government side, there is this renewed focus on value creation and privatization and capital efficiency. Some time back, there was this circular from the Gujarat government where the state PSUs had to mandatorily pay out a certain portion of profits and focus on buybacks and things like that. So we have seen the Air India privatization, a lot of things have been put out for privatization. So I think this is a space where there could be selectively opportunities to avail of. This space is very tricky. I'll grant that. Sometimes one may get stuck, but if one is careful about investing here, there could be opportunities.
Okay, fair enough. Give us a sense as well as to what the outlook is when it comes to the entire auto sector as well. Do you believe that it has been, a lot of the concerns now in terms of supply side pressures as well as the semiconductor shortage, etc., are now behind?
So auto is an interesting space given that because of various factors, one was a cyclical downturn, then the pollution control requirements were steep, which resulted in a lot of price increases. So the auto sales have been restricted for quite a while now. And even now, the overall numbers may not look that great if you just look at in terms of number of vehicles sold. But there has been a big shift towards buying bigger vehicles or buying pricier models or the top end variants. And this shift has been there from small cars to compact SUVs and SUV kind of things. And after a long time now, even demand seems to be reviving in a cyclical upturn. So this is a space I think you rightly mentioned to the semiconductor shortages and part shortages some time back. I think we are coming off that period and things are normalizing here. And this space has not done anything for a while now. And they look poised for better times ahead.
That's the view coming in on the entire auto space. And on that note then, Rajiv, it's been good to have you on board. Thanks so much for taking time out, joining in, sharing with us your outlook on the markets. Let's just quickly revisit the markets, and at the current juncture, we're staring at about 18,180 on the index. You've got this mid-cap index up about 200 points, and the gains are being seen across the board. TCNS clothing under pressure, Gujarat Ambuja exports down and out, Bank of India, something like a Coal India as well as Adani Enterprises are some stocks under pressure, while Marico, IndusInd Bank, BEML as well as Amara Raja are holding out quite comfortably in the green. What's the outlook then from Ravi Dharamshi when it comes to financials and manufacturing? Well, he believes that these are the mega themes for the coming decades. Let's listen into what he has to say.
I think out of the $40 billion outflow that happened, $20 billion went out of financials. Now you just juxtapose it with the fact that US regional banking is facing a severe crisis. The larger banks are being called upon to support the smaller banks. And of course, yesterday Fed made a statement that, that was an exception. It's not likely to happen. But what that tells you is that elsewhere, there are problems created by the lending sector. While in India, it is the strongest sector. In fact, nobody talks about an asset quality deterioration or any of those things. All we keep discussing is, will there be an impact on the NIMs? Is the growth going to be high enough or no? And in fact, I find financials as the only place in the market where there is a combination of growth as well as value. Most of the places have growth, then the valuations are not in your favor, or if the valuations are in your favor, then there is no growth on the horizon. So financials is the only place which has growth plus value, and will be the first port of call for any foreign money that will be coming into India. And I think what will happen is maybe the second tier and the third tier rung in the financials will also start benefiting from this. So now we are witnessing probably some change of guard. We have already witnessed a change of guard in the large banks. Probably we are going to witness a change of guard in the large NBFCs as well. So some of the performing ones will probably get outpriced before they even come down.
Or are we from a real recovery in pharma where you would say that the excitement of 2021 is over and the pain of 2022 is something what markets have factored in?
So we had almost 16, 17 months of consolidation period. So clearly, we dealt with the storm in a very, very mature way. It was more a time correction. We have digested all the bad news, and we have digested the euphoria of 21 as well. See, there were some sectors which ended up, or some companies that ended up losing 50, 60%. Otherwise, most of them managed to hold on to their gain with a 10, 20% kind of a loss. So I think that period of correction, consolidation is getting over. The period of wealth creation is coming back as RBI has already paused, and some of the other factors of profitability are also coming into favor. So basically, see, India never had a balance sheet problem. India only had a P&L problem, and that was coming from the raw material inflation, freight cost increase, and some slowdown in growth. I think the raw material inflation has already eased, freight cost has already come down. The growth slowdown that came about has kind of been factored in most places, but there is probably export-facing sectors still have some amount of growth slowdown, maybe a couple of quarters. But besides that, I think at an aggregate level, India has recovered very well. And once growth comes back, in fact, the operating leverage will also come back, with leading to margin improvement. In fact, this quarter, we are already witnessing some of the leaders in industrials, manufacturing, auto ancillaries, financials are seeing some margin expansion, which was not an expected phenomenon, I would say.
Ravi, hi, morning. We've sort of borrowed this line from you, the manufacturing renaissance, as you so well described it. And, you've talked about some top emerging themes in order to capitalize on this manufacturing growth. So can you just, walk us through what exactly those are?
So, I think confluence of factors. One, China wants to move away from manufacturing. Maybe it is because of pollution issues, maybe because they want to move their economy away from export-oriented to consumption-oriented. China wants to move away. Second is, world wants to move away from China in terms of their dependence, because of their over-dependence on supply chain terms on the China. And India has a huge populace that needs employment, and the kind of employment that manufacturing can generate cannot be generated by services sector. So we have no choice but to grow our manufacturing sector. Now, government is taking all the steps required to give the boost to the manufacturing sector. But it is not an easy journey. But we are already witnessing some early signs. So, for example, in electronics, I think we are in mobile, especially within electronics, we have become net exporters. I think that's a huge benefit for Indian economy. So we had a structural issue because we always used to run deficit versus most of our trading partner. And the number two item after crude was electronics that we were importing. And if we can start within electronics, mobile was the largest component. So now if we can start that manufacturing locally, I think we have a very good chance of correcting that structural flaw in the economy. So I think beneficiaries of that, the domestic electronics manufacturing outsourced vendor is one place that really excites us. I think there is a long runway. These companies can continue to grow at 30-35% kind of compounded for a long period of time.
PN Vasudevan, Managing Director and CEO of Equitas Small Finance Bank, joins us now. Mr. Vasudevan, good morning. Thank you for joining us. Now, NIMS for the quarter, or NIMS rose for the quarter gone by, but the street is worried that NIMS have actually peaked. Where should we see them in FY24, and at what level do you think they will normalize?
Yeah, see, our normal NIMs are generally in the range of about 9%. It's been there for quite a few quarters now. We do have a rising interest rate scenario. Our cost of funds has gone up to 6.6% in the fourth quarter from 6.4% in the third quarter. So definitely cost of funds is rising, and I think the cost of funds is set to rise further over the next 2 quarters, as some of the old deposits at lower rates will get replaced by new deposits at higher rates. So there's bound to be a further increase over the next 2 quarters in terms of our cost of funds. Part of that cost of funds increase we have passed on to the borrowers by way of raising our interest rates also. And part of that cost of funds increase, we are able to absorb by internal efficiency improvements in the system. So on a combination basis, we do expect that the current level of NIM should sustain in the short term. In the medium to long term, the NIMs might come down as we introduce new products which will have different type of operating cost metrics. So as that happens, the NIMs might come down, but proportionately we expect the cost of operations to also come down so that the net spreads may still be protected.
You guided for a loan growth of 25%, but you have also grown at 35% in FY23. Given the tailwind for microfinance and small business loans, do you believe that you can sustain this kind of growth on a higher base?
So, see, we do operate in segments like, the small business loan, the used commercial vehicles, the microfinance, and affordable housing finance. All of them have a very high level of unmet demand in the market. So, generally speaking, demand is not really a constraint as far as Equitas Bank is concerned. So it's all about our internal capability to manage the risk arising out of growth. That's a more important aspect as far as we are concerned. And, last year as we guided for a 25% growth, but ended up with around a 35% growth, largely because the collections were extremely robust in the second half of the last year. And that kind of, propelled the disbursements also to record levels. However, for FY24 and going forward from there on, we still guide for a growth of anywhere in the range of 25 to 30%. So that's our sweet spot. I think between 25 and 30 is where we generally should be, looking for growing up the advances.
Right. You're also guided for a 1.5% credit cost in FY23, and microfinance and small business is fragmented where it can be tricky. So what is your own sense on credit cost guidance, not just for FY24, but for, the medium term as well?
Yeah, so gross advances increased by 12% plus in this financial year. The guidance we are giving again at around 11 to 12% for March 24, for the reason being that the base is now high and...
Right. You also focused on deposit growth, which is a strong one in a tough environment. How sustainable is the 30% deposit growth number? And also you're looking to work on your current account growth, which has been a bit of a challenge. How's that journey coming along for you?
Yeah, so our deposit growth was quite robust last year at about 34%. And this year we continue to expect deposit to strongly grow, because we need around 25-30% growth in deposits to support an equivalent level of growth in assets. And so we are geared for that. And we have a sufficiently large number of branch network to enable us to mobilize the deposit required for business. In terms of the retail deposits, retail term deposit, RTD, we have done fairly well last year. It grew by about 25%, but this year we expect that to maybe even inch up a little bit more than 25%. In terms of the CASA, our CASA ratio is around 42% as of March 23. And it's going to be a struggle to help retain that through the current financial year, because you know that the interest rates on deposits have become very attractive. You know, 1 year deposit attracts a rate of around 8%. So customers who have some amount of cash in savings and who are willing to, keep it away for about a year or more would prefer to move it to a term deposit rather than keep it in savings. So the holding that 42% is going to be a challenge, and that's something that we are really seriously working on multiple areas and fronts to try and retain it at 42% through the current financial year. And in terms of current account that you mentioned, we have been putting a lot of efforts in the past, and some of that has borne fruit last year. If you see, our current account balance has actually grown last year from around 600 odd crores to 950 odd crores by end of the year. So it's a pretty decent growth that we saw last year on current account. And again, it's going to be a challenge to retain and grow that further, but both on CA and on CASA, a lot of effort from our side to ensure that, we retain a pretty healthy ratio of overall deposits.
Mr. Vasudevan, morning. Now, given that you have said that margins will sustain and your cost to income as well will remain stable, what is the outlook on ROAs?
So we have been always mentioning that as a business model, we want to generate an ROA in the range of 2% plus. That's what we have been always mentioning for quite some time now. And so ROA of anywhere around 2.25 to 2.3 is something that is the basic level of ROA that as a bank we would like to always commit to and try and deliver. So 2.25 to 2.3 is something that we should expect to see going forward, subject to no other black swan kind of an event coming up. Otherwise, this should be our steady state ROA going forward.
And, before we let you go, given that the markets clearly appreciate a stable leadership when it comes to banks and, of course, companies across the board, I'm sure the street is curious to know that we can safely assume that there's no question of you leaving your position. Where is the bank when it comes to your extension? Had there been any talks?
So my current tenure ends on 23rd of July this year. So we have applied to RBI. The board had approved a 3-year extension about 3-4 months back, and post that we have applied to RBI for an extension of 3 years. So we are awaiting the approval and feedback from RBI on that particular account. In terms of on an ongoing basis, yes, there was this issue that I did want to leave, but then I reversed and now we declared that I'm not leaving and I'll be staying back. Now there is no question of going back on that commitment any further now. As per RBI guidelines, I am allowed to continue as the MD CEO of the bank for a total of 15 years, and I have completed so far around 6.5 years. That really leaves me with another 8.5 years of tenure left, subject, of course, to RBI approval and shareholder and board approval, and of course, God's grace. So subject to God's grace and subject to approval from RBI and others, I should be here for the next 8.5 years.
Mr. Vasudevan, great to have you on the show today. Thank you so much for highlighting all about your earnings and the future visibility. Let's just take a quick stock of where the market has settled in at. Not bad actually, 112 points higher, 18,245 in the Nifty futures. IndusInd Bank has recovered all of its Friday's losses, 5% higher for this one. In fact, it's the biggest Nifty mover. M&M, Bajaj Finance, Kotak, Hindalco, Hero MotoCorp and even Axis Bank, they are the ones which are doing the trick. The breadth of the market is well looking strong. Marico reacting to its numbers. Manappuram is covering some ground, 3.25% higher. MFSL and Piramal Enterprises are your other movers this morning. We'll take a very quick break on that note, but come right back. We've got lots of earnings to discuss.
Right now, markets are doing okay. We've retraced, and this is not because of a comeback in HDFC Bank. This is largely because global cues are strong and supportive. So there are a lot of factors at play which in a sense are helping the market. Global liquidity, FIs are back, stability in asset classes, all of them put together. I guess the purple patch for Indian market continues. I mean, we've added 1,000 points plus, 16,800 has now become 18,200. That's about 1,400 points in just less than 1 month. That's a comeback, and that's a comeback for an oversold market. While we're talking about Aditya Birla Fashion coming back because it's a share swap, and it's a share swap, but for TCNS minority shareholders, I think they've been shortchanged. Why should you be getting shares of Aditya Birla Fashion? Maybe you're not interested in the business. It's a business where the promoters are interested in getting a share swap. But TCNS Clothing, if you bought it for the uniqueness of the ethnic brand W they have. And then suddenly you would be clouded with different other businesses. And the deal's been done at a discount, which means for TCNS Clothing shareholders, it's too late to sell now. Unfortunate, share swap is the only way out, but just leaves you a very bitter aftertaste that why would the promoter do such a thing, which in a sense is not such minority shareholder friendly. Digant Haria joins us. Let's take our conversation forward with Digant to understand that what he makes of the numbers which we've got from Paytm. And Digant, I've got 3 brokerage reports. All of them are saying, we told you 1 year ago that Paytm was always a great story to buy. Are the last 2 quarters endorsing just the obvious?
So Nikunj, hi, good morning. See, Paytm, all the positivity that you see has come on 2 accounts. One is that they have really cut down their costs in the payment business. Payment business was the backbone of Paytm and a loss-making, part of their overall business. So they have controlled the losses there. That's number one. And number two, they have done a good job in terms of loans. So we all were sure that payments in India is not a profit-making business. So what you have to do is you have to cross-sell something to the customers who are there on your payment platforms. And loans was the most sort of popular and the most logical thing to do. They have done it. They have done it quite well. So this year they have had around 35,000 crores of disbursements through 3 or 4 NBFC partners at the back end. So which is why there is this excitement. I believe that this excitement will be tempered in the next year because of 2 reasons. One is that the competitors like PhonePe, Google Pay, they are also eyeing the lending business very aggressively. So next year you will see a lot of competition coming in for Paytm. Right now Paytm definitely has an early more advantage. Next year competition will come, and then let's not forget that at the end of the day they will need RBI's blessings if they have to get an SFB license or an NBFC license and build their own balance sheets. That's point 2. Point 3 is that if lending is going to be the big driver of profitability and turnaround in Paytm, then in the markets value lending business on price to book and not on like 10 times price to sales or 30 times price EBITDA multiple. So I think it's good. The delivery on the lending business is quite good. But I think, we still have to put valuations at a rational level, which definitely does not appear right now.
Yeah, valuations have to be at a rational level. What is the benchmark you are using to decide that?
So Nikunj, if we just do some crystal ball gazing that, 2 years or 3 years down the line, if these run rates continue in the lending business, maybe Paytm can do 1,000 crores of EBITDA. It will be the first fintech to do that kind of an EBITDA number, and not adjusted EBITDA. I'm talking about the EBITDA which you and I really like to look at. So that EBITDA of 1,000 crores, but we're still trading at market cap which is close to 40,000 crores. So I don't see that if somebody is getting excited at these levels and buying the stock, it's not a multi-bagger. But yes, we've come a long way from the negativity of a year back when things did not really look great. So now at least there is a hope that the lending business can, bring that turnaround. 2 barriers to that. One is the RBI's blessings on the way, all these fintechs do businesses. And second is that, if lending becomes a primary driver, then we don't value it at, 10 times price to sales or 30 times EBITDA. We value it at, price to book or price to earnings.
Digant, hi, morning. What is the outlook in terms of the loan book quality for Paytm? Because we know that they don't lend, but do you believe that it affects the fees that they earn on their loans? Is there any sort of a downside risk there?
So I think right now, they are lending. There are 3 businesses. Okay, they lend the BNPL. If you shop, you get loans for that. Then you get personal loans, and last is you get merchant loans. So India has these lakhs of kirana shops. They also take loans from Paytm. So I think credit cost, it's too early to say. We are very much early in the cycle. I would not really worry much about credit cost right now. Next year when competition kicks in and there is a lot of chase to increase the loan book, that is when credit cost worries will also come. So everybody has to go through the cycle, and I think Paytm will also have. But I think it's too early to worry about credit losses because this is a very small loans they give. They give 10,000 rupee, 50,000 rupee, 1 lakh rupee loans, and they give it to lakhs of people. So at least that way the risk gets diversified. But yeah, it's an untested area. We'll get to know better about credit behaviors in a year or two from now.
Okay, fair enough. Given the fact that in the month of December last year, you did have Vijay Shekhar Sharma vowing that there would be zero cash burn or they would look at ways to reduce that, brokerages tend to allude to the fact that the cash burn will end only a few quarters down the line. What's your outlook?
See, I think I would say the cash burn will end only when the lending business really becomes big, because see, you have 10 crore customers who are there on the Paytm platform. Now to keep them engaged, you have to spend some amount of money. There is no going back. You will need some employees, you will need to run some schemes, you will need some tech support. So it's not easy for them to reduce the cash burn in the payments business. What they can do is they can contain the cash burn and eventually they can grow the lending business so that the profits from lending eventually translate into the bottom line. So I'm not very hopeful that the cash burn on the payment side goes away so fast because the phone pay will also become aggressive in times to come. So that is a space where they'll have to keep burning some money. But lending business is what we are most excited about. That this is a space where Paytm is doing something which the banks don't do.
Yes, indeed, fair enough. And just a quick outlook on the stock, given that it has been seen quite an overhang, priced at close to 3 times book now. Very few times is a stock like HDFC, for instance, priced like that in the last 10 years. What's the outlook on Paytm in terms of the stock price opportunity?
So you're asking on Paytm, the stock price outlook. So yeah, Paytm, as I said, I feel that it's still 2-3 years down the line, even if they make that 1,000 crores kind of EBITDA, not the adjusted, but the ones that we measure. I think stock is still quite expensive, and let's not forget there's an RBI overhang, there's a regulatory overhang, which is there on the entire fintech sector. So if somebody is looking at long term, I think this price may not give you great returns. You have to wait for bad days. You have to wait for days when RBI acts against these entities or something like that. I think anything below like 450, 500 is the place where you have good margin of safety, considering that a lot of things are new in this business.
Was actually an HDFC that I was talking about in terms of being priced at 3 times price to book. So just wanted to get in your take on what the outlook is on HDFC as a stock. Apologies.
Okay, sorry. So HDFC, HDFC will has a big challenge in terms of garnering deposits because they are going to digest a very large acquisition, which is the home loan, the HDFC Limited, and for that they have to open branches, give higher rate of deposits versus SBI or ICICI. It's the first time in last 10 years that HDFC is offering higher deposit rates across all maturities, and that is how it is getting this deposit growth. So I still think that let the merger get digested. Let us see 2-3 quarters of merged numbers. That is when you will get a clear clear sign on HDFC that yes, this is a 16-18% kind of compounding story. I think another 2-3 quarters for HDFC Bank still looks a little challenging versus say an ICICI Bank, which has absolutely no challenges, nothing to complain about, nothing to worry about. So HDFC Bank, in my view, will remain in this 1600 to 1900 range for 6 to 12 months till the HDFC Limited merger is well digested and the nuances of that merger are well known to the markets and the analyst community.
Right, Digant, great to have you on the show and glad that you could take time out to analyze HDFC Bank as well as Paytm. Okay, let's move on. Let's talk about what's buzzing in the market right now. We've picked up a fair bit after that quiet start that the pre-open rates as well as the SGX Nifty were indicating. We've made it back to that 18,200 trend. What's buzzing? Let's take it across to Norresh, find out what's on his chart buster list.
So that would be a chart of Ambuja Cements. The stock fell from 500 odd levels all the way to 300 to 330 band. For the last 3 to 4 months, it has been slowly and steadily picking up, has started making higher bottoms. But on the upper end for the last 4 to 5 times, every time it came to 400, 405 levels, the stock retraced back. Finally, on Friday as well as on today, it has made a good closing move above 400 levels. So that's a short-term breakout. You could call it a triangle breakout, which has an upside towards 440 to 460 in the short term. Would keep a strict stop loss at 390 and keep this trade for the next few weeks.
What's on your chart buster list?
Well, I've looked at the charts for Nifty 50 and I think interesting prospects for the indices because over the last 4 or 5 months, we've seen two classical trending nature for the indices. So from the December 2022 highs, the index formed a classical channel pattern down. I call it classical because there were multiple times when the indices took resistance at the top end of this channel resistance line, and multiple times the indices took support at the lower end of the channel line. And it actually acted as a zone of major supports in times of sharp correction, major resistances in times of a bit of rally or euphoric upside. Now on the upside, over the last 2 months, specifically from the March close where we double tested that zone of 16,800, we've formed a classical channel pattern on the upside. So for short-term traders who are actually looking out for a sort of an entry point in case if the index corrects, I think the max correction on the downside could be limited to this trendline zone. So as of now, it's almost at 17,850, 900. Maybe over the next couple of days, the trendline can shift higher to maybe 18,000 levels, which could act as a major support. So we are not expecting major correction on the indices, even if it goes into a short-term aberration. But I think 18,000 levels approximately could act as a major support, and that could be a point where contra traders may come back and look out for building long positions back again.
Okay, let's talk stocks then. And Kunal, what's on the radar?
So again, 2 buy calls. The first one, which I'm suggesting as a buy, is actually on L&T Finance. Interesting charts for the stock over the near term. It's been showing signs of very good breakout over the near term. And now heading towards the breakout, the 97 mark, the stock has actually moved up higher in just the last few minutes. So I would suggest a buy with a target revised on the upside to 106, stop loss at 94. And the second stock which I've been bullish on over the near term is DLF. Again, interesting breakout, stock breaking past our 430 levels today. 455 as in targets revised on the upside, stop loss 422.
Right. Naresh, what about your stock specific list?
So first is a buy on Power Grid, a new 52-week high on all-time high on dividend adjusted basis. The stock slowly and steadily making a move. The trend still remains positive. A stop loss at 238 and a target price of 260. Second is a buy on Axis Bank, which is setting up for a trending move going forward above the 880, 890 mark. Has been retesting 860 mark and reversing from those levels, expecting it to break out going forward. A stop loss at 860 and a target price of 920.
You have it, all of those top chart buster ideas coming your way from Kunal as well as Naresh. Time to move right on then, and we've got with us the Managing Director Mani Meklai of Union Bank, the CEO as well, joining in to talk a little bit about their quarterly performance as well as outlook on deposit growth and return ratios. Good to have you on board. Thanks so much for joining in. To begin with, you've reported the highest ever net profit in around 30 quarters. What has really contributed to this?
Before I get into the profitability part of it, let me just briefly tell you on what we have achieved during the quarter and for the year as a whole. We have given a year-on-year growth in deposits to the tune of about 8.26% and credit growth at 13.05%. Consistently, we have been growing in these two areas. RAM has performed very well, 14.94% in the RAM sector. We have done profits to the tune of about 25,467 crores. That is what we have done. Our increase in profitability, that is net profit, is to the tune of almost 61.86%. If you remember, we had given ourselves 2 guidance in the beginning of the year that we will cross 19 trillion of businesses and at least 15% growth in our operating profit. And these two focus areas was there for us from the beginning of the year, and that has what has led to the healthy growth in the net interest income and in the fee-based income. If you look at my net interest income, it has grown by almost 21.2%, and even in my fee-based income we have seen substantial growth. Fee-based income meaning out of my own books, like your third party, and we have a wonderful product for the CMS, that is the cash and the payment systems, where we have got a wonderful product, and through that we were being able to register a growth of almost 23%. Plus, the third most important part for us was, from the return of accounts or our asset quality, where we were able to recover substantially during the quarter from our NPA books, and we were able to recover quite a substantial number, almost like 5,500 crores we have recovered from our return of numbers, and during the quarter itself we did about 2,300 crores in our written off numbers, and that's the reason that we could show a very healthy growth. It is not just one parameter that we have been focusing during the whole year. We have been taking various measures to see that whatever we do, we are able to register good growth in all those numbers. Thank you.
Do you believe the advances growth rate will slow down from the current pace of 13%?
We had given it, ourselves a guidance in the last year to about 12 to 14%, and then we have achieved our 13.05% of growth in the last year. And during the current year, we are hoping to have an advances growth of 10 to 12%. And this is what the analysts have predicted, that this year the growth will be to the extent of 12 to 13%. And in keeping with the market and the systems, we are hoping that we will also grow at 10 to 12%. To give you a small perspective, as on date, I still have about 35,000 of sanctions with me, and this will help me to generate further income. You have also seen that during the year we have created a lot of verticals. We look at the mid-corporate segment or the retail loan segment and the MSME loan points. We have created LCBs, 14 of them. We have also created something called the CRC, the corporate relationship cells, during the year. And all these various verticals that we have created will propel us to achieve the targets that have been set up for the bank.
Do you believe that the stress with respect to asset quality is likely to rise further in next financial year?
Stress would be there. This is a normal course of business, and the economy also. So stress would be there in various parameters, and we have seen the interest rate hike also substantially in the last 2 years, and this is also added to the stress. But I am sure that we will be able to manage the stress substantially. This year, the stress SMA 0, 1 and 2 books were limited to 0.62% of my total book, but I'm sure that for the current year also I will be able to give that kind of a guidance to ourselves. If you look at what we have done is most of our stress is looked at very seriously by the bank. We have got a 5-pronged approach, right from the bank calling up the stressed borrower as soon before even the accounts goes into the SMA 0 position. The SMS goes to the customer. There is a call that goes from the branch. There's an RCOC, the regional call center calls him. There is a foot on street where the customer are visited by our people or through my subsidiary. And the last but not the least, the call centers also help us in recovery. So with this 5-pronged approach that the bank has taken, I'm sure the stress will be maintained, and I'm sure that we will be able to maintain at the same level at what we are having it at this year.
Right. So you've said that your NIMs will be maintained at 3%. Will you be able to maintain margins in high interest rate scenario, you think?
If you look at my book of 8.10 lakh loan book, out of that almost 50% of my loan book is covered by an MCLR, and so this is to be repriced once in a year. So out of that, just about 50% of them have been repriced during the current year, and going forward the remaining 50%, if you look at even in as at September alone, I've got about 41 to 50,000 crores of my loan book to be repriced during the year. So I'm not seeing any reduction in my margins. Plus The deposits rates have also come down. What we have observed in March, about 40 to 50 bips has come down in the interest rate after the pause taken by the Reserve Bank of India. So we are hoping that the NIM will be at the same level. We are hoping to maintain the NIM at the 3% level.
Lastly, what's your guidance on ROA, ROE in the financial year, and by when do you think you're going to move towards an ROA of 1%?
Yeah, return on assets, we are hoping to, at least 25 is what we have given the date that it will be at 1. In the current financial, for the quarter, we were at 0.88, and for the year as a whole, we were at 0.69. We are just hoping that we will reach 0.75 at least at the end of the fiscal.
All right. Thanks much for taking time out and joining in and giving us a view. That's the word coming in from the management of Union Bank, talking about a 10 to 12% advances growth and saying that they will maintain their credit costs. That's Union Bank at about 75 rupees. And from one bank to another then, it's been a steady quarter for DCB Bank as well. We've got Mr. Murali Natarajan, the Managing Director and CEO, joining in live to talk a little bit more about the outlook on the bank. Let's begin by discussing your net interest margins as well. In terms of the fact that we've seen a surge in the cost of funds, your margins still continue to expand. So what's the outlook for FY24 there?
So our business model is operating on a margin of somewhere between 370 to 375 basis point. We have two types of books in our advances. One is linked to MCLR, where as and when cost of funds change, we can change the MCLR. However, we pass it on to customer on a quarterly basis. With respect to EBLR, it is linked to policy rates of Reserve Bank of India. So as and when that changes is when we make the change in EBLR. Now what has happened is there has been some changes in the EBLR in the past few months. However, the cost of funds is still to catch up because deposit rates have moved up, although it seems to be stable at this point in time, the deposit rates. So I expect that our margins from a business model point of view will still operate around 370, 375 basis point. Of course, our intention is to continue to expand margin, but I think this 4.18 that we have right now may not be a sustainable kind of margin. Having said that, margin also depends upon the mix of products. As you know, we are a very retail SME focused business. We have only about 8 to 10% in corporate. Also, as we continue to put our emphasis on CASA, I believe that also should help us to sustain the margins. But 4.18 looks like a slightly higher margin than what our business model seems to indicate.
There is a fight for liabilities. Everybody wants to get that next deposit check from the depositor. How does a mid-tier bank like DCB make sure that the next liability check comes to you? Because every bank is offering a better rate, every bank is offering an internet solution, every bank is offering you benefits of taxation. So what are you doing to ensure that you do not lose when there is a war of liability?
That's a good question. We have to constantly innovate our deposit products. We have to constantly innovate our deposit products. For example, we have changed the interest rates in savings account to make it attractive for smaller deposit customers. We are planning to introduce a couple of more nuances in our savings product so that customers find it attractive. We have to constantly do marketing and micro marketing, and we have to make sure that the branch scorecard is stacked in such a way that the frontline team focuses on deposits. It's not easy, but we have been very successful so far, and we believe that we'll be continuing to be successful.
When interest rates they start peaking upwards, they will, whether it is this quarter or next quarter, do you see a situation where things on the credit front will also start normalizing? Because higher interest rate historically have been an indication of credit growth as well.
So, I'm not sure exactly what you are looking for, but looking at the interest rate situation now, now that there is a pause in, at least for the time being, in the policy rates, I believe that the interest rates will remain stable at this level. We see in the segments that we are targeting strong demand for loans still, and our confidence in terms of doubling the balance sheet every 3.5 years at the current rate of growth remains intact at the moment. And as far as credit cost is concerned, one of the biggest challenges that we have dealt with is the COVID-19 pandemic. As you know, we target SME, MSME segment, which got most impacted by the pandemic. Yet, we didn't get into any loss situation. We didn't have to raise capital. Our capital position is still strong, and we have bounced back very strongly. In fact, our credit cost indicates that we have bounced back strongly. Yes, market also has done well. We believe that our business model operates around 40 to 50 basis point type of credit costs, and we are confident of maintaining even at the current interest rate.
How do you exactly see the retail stroke the SME book moving? Because those are the two differentiating factors for DCB. You are looking at a retail focus and a SME focus. You are lending to pockets where other banks are perhaps avoiding or they are not ready to take that risk. How do you see this strategy moving, and how do you think you will be able to price your loans?
So, I don't know about the other banks. We have been targeting this segment, SME, MSME, for the past now 14, 15 years. Right? That is point number one. Point number two, our average ticket size is about 30, 40 lakhs. Within SME, there are many sub-segments. We have decent analytics and credit capability, also backed by strong in-house collections capability. So, we understand this segment very well. The demand in this segment at the kind of ambition that we have of doubling our balance sheet in between 3 to 3.5 years seems to be intact. We have also invested heavily in the frontline staff in the last 1.5 years. If you see our headcount, it has gone up by almost 27-30%. And the entire capacity of the headcount is still not realized. So, we believe that the way the disbursal volumes are growing month on month, quarter on quarter, we still have runway to grow this balance sheet in the kind of numbers that I talked about. So, we have reasonable confidence in growing the balance sheet at, say, doubling in 3 and 3.5 years, and there is enough market opportunity here.
At the current growth rate at the current credit growth rate, let me rephrase it, at what point in time you would be forced to come back, or you would be tempted to come back to the market to raise capital? Because beyond a point, you would be needing fresh capital to grow.
Yes. So, our tier 1 is above 15%. Recently, we raised a tier 2 of about 300 crores. Now, the business model is such that we do secured lending. 80 to 85% of our book is secured lending. Our capital consumption risk weight is only 53-54%. So, it's a very capital efficient model. Given the current growth rates, we don't see ourselves requiring capital for at least 12 to 15 months. Of course, if the market presents itself with an opportunity, we will consider. We have taken we are planning to go to AGM with an enabling resolution. But looking at the current trends, we believe that at least for 12 to 15 months, we may not require additional tier 1 capital.
Can I say that from your vantage standpoint, this credit cycle, what we've seen, is beyond a sugar rush, and for next 2 to 3 years, you think this kind of a credit growth rate will sustain?
Looking at the demand, looking at our frontline capacity, looking at what we achieved prior to COVID, looking at the numbers that are now stacking up, which are pretty similar to pre-COVID-19 levels, we have reasonable confidence that credit cost should hold at about 40-50 basis point, which is what it used to be prior to COVID in the same business model. And our growth rates should help us to double the balance sheet in 3 to 3.5 years.
The industry, and I'm using State Bank of India here as a benchmark, is talking about a 15 to 17% growth or 14 to 16% growth. And that's a large balance sheet. India's largest bank is talking about a 14 to 15% growth. So can I say that the multiplier, at least for DCB, would be 1.5x of that, bare minimum?
We don't look at it like that. We don't want to compare with such wonderful banks like State Bank of India. I would like to stay with DCB Bank. The business model is such that you need to be cautious because we are targeting SME, MSME. Compounding at 18-20% per annum profitably in a profitable manner is a good way to grow your business, and also you have to maintain proper liquidity parameters given the kind of competition that is there in deposit. So as we see momentum building, obviously we will aim for higher growth.
And final question, what about the fee-based component? Every bank has an ambition to really become big in terms of fee-based component. Banks have three, I'm just bringing this out for our viewers, just bear with me. Every bank had three basic revenue lines. One, transaction, which UPA in a sense has nullified that at that complete vertical. Second, fee-based income. And third is money which they make from lending. So you've spoken to us about the lending operations, where and how they're headed. Let's understand the second component, the fee-based component. In a competitive world where fintech is disrupting every component of fee-based income, whether it is insurance or brokerage or even for that matter wealth management, where do you see standing?
Our intention is to grow our fee income, and we are talking about core fee income. We are not talking about treasury income. We are not talking about PSLC, which can be up and down depending upon market conditions. The core fee income is growing strongly. If we grow our balance sheet by 18-20%, the momentum, the training, the branch scorecard, the products that we have seems to indicate that we should be able to match the fee income growth with our balance sheet growth. In the year-to-year comparison, if you look at the third-party fee distribution, the core fee income in terms of processing fee, the ATM fees that we get, the fees that are related to CASA, all have done very well. So we have reasonable confidence that our fee income should grow pretty much close to the balance sheet stroke advances growth.
All right, really appreciate your time. So glad that we got a chance to interact with you, and we must make it a habit not to wait for 2 quarters for our next interaction. Only we must meet more often.
Thank you.
Let's take a break. Markets are doing quite okay. We've picked up from where we left. Paytm is the star. Aditya Birla Fashion, after that brief mid-day turbulence, has come back. But for the shareholders of TCNS, I think the verdict is pretty simple. That the minority shareholder in this case get a share swap at a much lower discounted price, and that is something which is having an impact on the stock price per se. 99 rupees down, almost 20% down for TCNS Clothing after that acquisition news.